All right, folks, welcome back. This is the weekend commentary for the ICT Mentorship for April 25th, 2021. Dollar index daily chart. And as you can see, we've been on the money. Just a recap of what we've been seeing and witnessing transpire. The old volume imbalance turn fair value gap acted as resistance, as we would expect. We targeted the sell side liquidity pool here. We did get that. In Wednesday's commentary, I said that we were accumulating in here. Accumulating what? Short positions to, again, make an attempt to get down below here and inside this buy side imbalance, sell side inefficiency. So Thursday, we had this run up, failed to take out Wednesday's high, and then aggressive sell off on Friday. So we're going to maintain our bearish stance on dollar until we get down to this area here. We'll have to revisit whether or not that's still warranted or not. Dropping into the hourly chart for the dollar index. Here's a hourly sell side imbalance, buy side inefficiency. And again, this is that old low on the daily chart where sell side liquidity resided. The market trades down, creates a low here, retraces back up into consequent encroachment, sells off, creates another smaller sell side imbalance, buy side inefficiency. Market trades back up into that, fails to take out this high. Notice that, because this is going to be important in a couple minutes when I review Euro and show you the contrast between it and the dollar index. So 2 times the market trades up into consequent encroachment during a time when the market is primarily on the daily chart bearish. So institutional order flow, trend, momentum, whatever you want to call it, the actual term is institutional order flow. It's bearish. So if it's bearish, where do you want your main focus? Looking for selling opportunities for dollar. You can see we had one here, we had that one here, and then we have another sell side imbalance, buy side inefficiency here. The market trades back up into it and creating an optimal trade entry as well, just for good measure, and attacks the sell side liquidity here. Now, looking at the euro dollar with the dollar index overlay. Now, this is created with TradingView. You can go on to either one of the charts. You can start, as I did here, by having a euro dollar chart and then hitting the compare tab on TradingView and then adding the Dixie. Okay, so it's the dollar index. And you'll have to come back to euro dollar's chart and change it to a line chart to make it look like this. Okay. So basically I have the annotations that you'll see on Eurodollar here just for reference. So remember this part of the video or come back to it so you can compare and contrast what I'm showing you here. We have a low, a lower low in Euro. At the same time, we see a high and not a higher high. This is SMT divergence. Okay, so what this is basically saying is inside of this imbalance, as you'll see on the euro, this run here was just a run on sell side liquidity, whereas this run here didn't need to take the buy side liquidity because it was being taken on euro, but it further emphasizes the underlyingly bearishness of the dollar because it doesn't even have the interest to go up here because it's already wanting to go lower. So the algorithm says, I'm not interested in going here. I've already done enough to go here. Now we'll go lower. The mirror image of that is in euro going higher. So when we're seeing this in areas and in PD arrays that we're looking for order flow to suggest bullishness or bearishness or confirmation to a trade idea, as we have here, this supports a trade with supportive analysis. It's not just simply saying, well, I have a hunch, or last time I saw this, out of 20 times, it's worked 18 times. It's nothing like that. It has statistical probabilities on your favor because you're actually seeing the crack in correlation between the euro making a lower low with the failure of the dollar index making not a higher high, but a slightly lower or equal. I'm plotting this line on dollar with the high. and this is being plotted for euro on the low, so that we're comparing and contrasting the two respective price points. Now we're moving into euro dollar. This is a daily chart, and you can see we have a sell side imbalance, buy side inefficiency. We just fell short of reaching up into on Friday, and we accumulated in here inside the fair value gap after hitting an order block, trading into that area and running higher. This fair value gap is a discount array, and the premium array next is the discount low here, consequent encroachment, and the premium high of the respective range here. Carrying that over into an hourly chart, you can see also that daily sell side imbalance, buy side inefficiency discount low. That's what this level is here. We just fell short of that. Prior to that, we had a buy side imbalance, sell side inefficiency here, and then the market trades down into this low and lower here. So what we're doing is we're creating a run on sell stops. After it starts to run, comes back down in, takes the sell stops here, and institutional order flow entry drill off of what? This breaker. This last up close candle prior to this drop down that was lower than this one. So what's the price swing we're looking at? Low to high to low. Last up close candle, that's your breaker. Extend that out in time. You can see it accumulating in here, essentially around the mean threshold of the middle of this up close candle. That's mean threshold. Extend that out in time. It's accumulating there with a run into this buy side imbalance, sell side inefficiency, and institutional order flow entry drill. So we had an initial run shallow on buy side liquidity here with this, but what is the underlying tone of the market? It's bullish for euro because dollar is bearish. Prior to all this, we had the run down here. Now we have the buy side imbalance, sell side inefficiency here. The market trades down into almost consequent encroachment of it there, and then we get it here. So we have the consequent encroachment, run on sell side liquidity, and then rallies higher. This is that daily fair value gap, this shaded area here. So we're digging into the fair value gap on the daily here, which is the reason why it was not required. Now think what I'm showing you here. Why doesn't it come down and completely close this buy side imbalance, sell side inefficiency, Michael? This is one of those levels that you said that it's likely to fill. So why doesn't it want to come all the way down here and fill that? I get this question a lot. This is answering that question right now, so pay attention. Which imbalance has more of an influence? Okay, in other words, if we were to put them in an hierarchy of or most authoritative, or who's the parent and who's the child, the daily fair value gap that's shaded here, that's the parent PD array. So it need only come back down into that and not the lower time frame imbalance here. Notice that? This imbalance starts here and ends here. So all of this buy side delivery and inefficient delivery of sell side. So it's all one-sided on the buy side. But on the daily, you have this imbalance in terms of the range. We're only going to look at from this price level here to there. Okay, so that's really on the higher time frame. The algorithm is going to seek to fill that more than this. So that's why sometimes an imbalance on a lower time frame stays open, and sometimes why I say I'd like to see this stay open and not completely close, because I'm referring to something on a higher time frame that has much more impact. It has much more authority over price. Whereas if you just looked at this here, like Instagram traders and YouTube traders that are familiar with my stuff, they'll be telling all their followers that, yep, it's going to come down here and we're going to take a buy. Nah. This is one of those things that I get angry about because they're misleading folks. And when people see that, they naturally think, well, that's the same stuff ICT talks about. And it doesn't work. See, it fails. It's flawed. It's whatever. No, they just don't understand what they're doing. Now, obviously, we go way deeper than this, but this is one of those things for your study journal, so you can include this. Why do imbalances stay open? It's because on a higher time frame, it's already rebalanced to what it's needed to rebalance to. And this is a clear illustration of that. And you might want to actually take a screen capture of this and include it in your study journal, because this is actually showing you the signature many times referring to why I want to leave, or rather see price leave open imbalances like this. Okay. Now I want to take a look at the economic calendar, and you can find this obviously as we've always done using forexfactory.com's calendar. Now for the filters, to filter this part of the teaching, this is the actual lesson per se of the weekend commentary. I want to cover why euro dollar traded the way it did. And before I get into it, I want you to think about what I talked about in the Wednesday midweek commentary. There was a premium PD array in the form of a fair value gap. I stated that we could go up into, and then it could sell off and go down, and then we'd have to look at buying it up at a later time, putting it on the back burner. I want you to think about that and also compare what the market was doing price-wise for the week up to that point in midweek Wednesday, and what was left for the economic calendar for euro. This is the entire week of April 19th through April 23rd. Notice there's a vacuum of high impact or medium impact euro news on Monday and Tuesday. You see that? How about Wednesday? Was there any euro news? No. Now Thursday, we come in like gangbusters with a monetary policy statement, which is high impact, and then main refinancing rate. This is at 7:45 a.m. This is New York local time, so it's in the New York kill zone. 8:30 a.m. ECB press conference, high impact. So right away, we have what? A lot of volatility expected. So what are we anticipating on Thursday? We're anticipating price movement, manipulation, but are we forgetting what the underlying premise of the week is? Lower dollar, higher euro? No, never do that. Always anticipate the algorithm working things out in a narrative that upsets that established sentiment based on the initial run or the run up or down into a news driver. Now, what am I saying there? Sometimes the market will give you this broken wing type effect. Like, that's what we're anticipating when we see these high impact, medium impact news drivers. On Friday, during the London Open, we have the French Flash Services PMI, and then at 3:30 a.m. German Flash Manufacturing PMI. 4 a.m. again, medium impact drivers, and then at 10:35 a.m. Friday, medium impact ECB President speaks. So if you look at the overall structure of how the calendar is laid out here, and we're focusing primarily on euro here, so I'm kind of giving you the basis as why I was anticipating what I was anticipating, why I said what I said on Wednesday's video, and why I felt it was likely to do what it did. So let's go over to the hourly chart. Okay, and again, this is everything that you've already seen here, but now I'm going to strip it down, take all this off for a moment, and let's just focus in on each individual day. So each individual day here, we want to include now the economic drivers and keeping in mind what the underlying institutional order flow and premise is for the week. That being Monday's trading, Tuesday's trading, Wednesday's trading, Thursday's trading, and Friday's trading. What are we anticipating throughout the week? Daily institutional order flow is bullish, and buys are ideal intra-week. Okay. On Monday, we see price doing what? Rallying higher. Tuesday, retracing. Wednesday, a little bit more retracement into this imbalance. Now, it's come down, yes, into this imbalance, but think about what I was showing you earlier as it relates to the hierarchy to the imbalance. The daily fair value gap has the most significant impact on price, not this really big, clear, obvious 1 hour buy side imbalance, sell side inefficiency. So it's come down into that daily fair value gap, and then it starts to rally here. And on Wednesday, I stated in here that we had this little fair value gap, and we could punch up into that, then fail and sell off and trade lower, more into this buy side imbalance, sell side inefficiency. We got that. Does that negate and completely cancel out the underlying bullish bias to the week? No. It just means it's coming down here to take what? Sell side liquidity. The manipulation was 7:45 a.m. monetary policy statement. They pump it up into our premium level. What's the public thinking? Buy, 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 buy. It's going up. Everybody on YouTube, everybody on Instagram, and everybody on Discord, Telegram. Oh, it's going to run to this high here. No. It went to here. With the news, sells off, attacks the sell side liquidity there. Accumulates here. So this is offset accumulation. You'll learn about this in later lessons, but for now, it's offset accumulation. It's accumulating longs with these sell stops as they offset their shorts from that PD array right there. Okay. As the market drops down, it accumulates the sell orders to pair it up with buying, allows smart money to accumulate longs here. Then the market rallies up. And then what's the next news driver on the economic calendar? Ooh, look at that. 10:35 a.m. ECB president speaks. Right here. What is it doing? It's going back into that imbalance right here. Because it's already come back in and closed the daily fair value gap down here. So it can accumulate those sell stops there, right here. And then rally higher, pick up more orders ahead of what? Running out that buy side liquidity high. Taking it back to the underlying narrative and the technicals as I teach it to you. The breaker, buy side imbalance, sell side inefficiency, institutional order flow entry drill, right below this low, 1, 2 run stops, rally. After it has done the complete closure of the daily fair value gap. Notice it doesn't completely close it here. It leaves that little bit of piece there. That's how you know sometimes it can come back and fill that, but not need to come back down here for the hourly. What I was working with and what I was outlining to you on Wednesday is what I teach later on, and this is taught in short-term trading. And when you get to that month, if I'm not mistaken, I think it's in month 7 content. Core content. It's consolidation Thursday reversal. Now, is this not what Eurodollar did? Exactly. What is the hallmark to this weekly profile? Because that's what I'm showing you here. I'm giving you, especially for the 2021 group, you're getting a advanced view of what you'll learn later on. And it's also basically what I'm doing every time I sit down with you each week. I'm using the very things that I teach you in the short-term trading month, number 7. So when you get to month 7, that content, those lessons are basically the framework to what I'm doing when I do the midweek and weekend edition. I'm forecasting the weekly profile in essence, but I can be wrong because no one knows what Sunday's going to open up as, and you don't know what Sunday's going to do going into Monday. So it's always like iffy, but sometimes it's really strong and I'll feel committed to tell you what it is I think is going to happen. And other times when I don't feel so confident, I'll remind you that, hey, look, it is Sunday opening and I'm not certain, but I'm going to tell you what I believe right now based on what Friday's close is. But how to anticipate this, okay? And as this slide says in that month's teaching is know the higher time frame discount arrays, which I walked you through today. I also pointed them out on Wednesday's video. And when the market fails to drop into that array, odds are Thursday will likely see the drive lower Thursday on a market driver news or rate release late New York session around 2 p.m. Eastern Standard Time. Now this profile really works well with FOMC related ideas, but it's always considered for me if the economic calendar is light on a Monday, Tuesday, and Wednesday starts the economic driver schedule where, as I showed you here, we didn't have any news, medium or high impact up until Wednesday. Monday and Tuesday was a vacuum of any news for Euro. So right away, when you see things like that, it's okay, it might do this. If you're bullish, if you don't know what the bias is, then obviously this isn't going to help you. But what is the underlying bias? The profile is bullish. So you have to have a market understanding of what you think the market's going to do. Then you start looking for weekly profiles, as you'll learn in month 7, which one to look for. And then you match up the economic calendar with what they're releasing. Now, I'm going to remind you, everyone says that the market's controlled by buying and selling pressure. It's not. Everyone says the market's controlled by technical analysis. It's not. I show you here, and I teach you more of it in month 7 and month 8, where I'm teaching you specific templates that the algorithm generically follows. Not all the time, but it is so consistent that it's literally like forecasting the future. Now, if I show you this diagram, if I went on YouTube and I showed this diagram here, this would be laughed at. Like, what is that? It's too elementary. It's too simple. It's too stupid. It doesn't tell you anything. It's vague. I've had that a lot from people that come into this mentorship and they don't really apply themselves. But I'm peeling back the veil and I'm telling you what it is I'm doing. I'm showing you here why and how I forecast the Euro this week. I've told you that we were bullish on Euro, bearish on dollar. I told you that daily fair value gap was likely to create the accumulation for new shorts on dollar and accumulation of longs on Euro. Go back and watch the video. You're downloading them, I'm sure. I can't change it once you get it in your hands, in your computer. But this is what I'm using. And you don't find it in Wyckoff. You don't find it in supply and demand. It's not in harmonic. It's not in John Murphy's technical analysis of financial markets book. Okay, it's nowhere. Chris Lloyd don't even know about this. Larry Williams doesn't know about it. And you're probably sick of me saying this stuff, but I have to repeat it over and over and over again because people simply can't accept that it all starts here. Not someone else, not somewhere else, but from me. Once you see that these generic signatures are present and you understand the characteristics of what makes them likely to occur, it makes forecasting price action much easier. You're not perfect. I'm not perfect. But these are some of the hallmark reasons why I'm so consistent with my analysis, because I'm following what the algorithm will generally look to do. These are like short-term little macros. What's a macro? Everything I'm showing you here and how the market dives underneath this low here, there. That's exactly, folks, listen, I didn't make this slide for this lesson. Everybody that's going to month 7 are smiling right now because they know that this lesson is in there. And when you get to month 7, you'll see it too. But I'm just showing you, okay, it's not after the fact, hindsight, cherry picking, make things form fit. That's the lazy people's excuse. But you see me doing it here every week. And not every week will it follow this profile. It'll follow other profiles. And here's the amazing thing that you need to take note of. If you can't clearly forecast a likely profile for the week, chances are you're not in high probability conditions. Wow. That means if you don't have a roadmap that clearly outlines based on the economic calendar and the institutional order flow that's present at the time, because there's profiles that are, again, like this profile is a bullish one. Well, what do you think the bearish one would be? The reverse of this, where it creates the high of the week on Thursday. Not necessarily the high of the week, but it has a reversal of sorts on Thursday, and it drives into the lower low on Friday. In other words, the big move really manifests on Thursday, just on a down move. Whereas in this profile is bullish when the market's bullish. Now, think about what I just gave you, because in month 7, you didn't get that if you've gone that far in the mentorship. I've just put those things together. I've just shown you how to put the daily fair value gap that did not need to go any further lower on euro to close in that hourly 60-minute buy side and balance, sell side inefficiency. And what you see here, that's mentorship. That's why these folks that have pieces, or they've quit, or they've been trained by somebody else that don't know what they're talking about, they just repeat what I've already said. They don't know what they're doing, folks. They clearly don't know what they're doing. And you're in the right place. Moving on into British pound. This one will be quick because, as you can see, it's been rather muddy back and forth. It's been short-term chaos. And I still favor it running to here eventually. I just can't time it yet. And I said on Wednesday that I favored this pair underperforming against the euro dollar. And it's done so. I stated that we would likely see a lower run on Wednesday, and we got that on Thursday. It ran through the low. And on Friday, just a little bit of a bounce. But we closed in all of this buy side and balance, sell side inefficiency. We got a really juicy level of buy side liquidity here. And I mentioned how this whole scenario would warrant a consideration of euro pound going higher. And it caused that very thing to happen. Again, go back and watch Wednesday's video. If you don't write these things down, it's a little underwhelming when I talk about it a day or two or a week later. Carrying everything over into the hourly chart, you can see here we have a nice buy side liquidity pool where it's dug into it here, as I mentioned on Wednesday we would likely do. And then we sold off, creating a fair value gap there, trades up into it, another fair value gap there, closes it in on Friday, trades lower, and then leaves the sell side liquidity here. So we are at one of those crossroads, if you will, where it could go higher to run here, or it could go lower first and completely close in this small little remaining portion there with the order block. So we could drop down here and then have something of a reversal, or it stays in consolidation, or it could go higher. Now, that sounds like, well, I could have done that, Michael. Right. So what does that tell you? If I'm telling you that, is this pair high probability? No, it's not. So far in this lesson, I've already talked about how we find high probability, how to frame weekly profiles, how you're going to learn what weekly profiles there are, how to use the economic calendar to determine what weekly profile is likely based on bullish or bearish undertones to the marketplace, and what if inefficiencies are more important than others. Why do some imbalances stay open and others completely close in? It starts from the hierarchy of the higher time frame down to the lower time frame. The lower time frames do not dictate the underlying narrative. They operate inside of it. That's established by the higher time frame. Remember what I taught? Number one, right out on Baby Pits, 2010. Interbank delivery starts and is hinged primarily on the daily chart. All order flow starts there. Anything less than daily is going to just be utilized for short-term imbalance and volatility. That's it. The liquidity is driven on that daily chart. That's where it's being pulled to. Whatever liquidity marker is on the daily chart, that's what's underway. It's drawing to that. Inside of that narrative, there's going to be little road maps of bus stops along the way, back and forth, up and down, up and down. Each one leading to another impulse leg that takes price to that ultimate daily liquidity pool or imbalance that it needs to trade to. That's all that's happening, folks. That's all it is. So it creates that volatility. It creates a reason to run for liquidity on all time frames, but they're all dynamically linked to that daily chart. All right, I want to talk a little bit about corn and the grain markets. So what we're looking at here is barchart.com. Again, barchart.com. And I pulled up the corn market. These are the delivery contract months, and you can see the cash price here. This is the front month, May 2021. Next month out is July 2021, and then the month after that, or next distant month, would be September 21st. And I want you to take a look at something right away. Do you see anything odd? $6.55 a bushel, $6.32 a bushel, $5.75 a bushel. Prices are going lower in the future, and they're more expensive as you are closer to real time. So if this is the nearby contract, this should be cheaper than this one, and this one should be cheaper than that one. It should be more expensive as we get further in time. That's a normal carrying charge market. That's normal. That's exactly what it's supposed to be like. If it has a backwardization like this, this is the recipe for a commercial bull market. That means we're likely to see sharply higher prices. It's real easy to rally higher and dynamically. Well, if that's the case, which month should we trade? Well, you go over to open interest here and notice that for the May contract, it's 231,000, and then July we have 739,000. Then the next month out for September is 221,000. So the most active is here. So right away you know that this is the front month, May, and the most active is this one here, July. So if you're going to trade grains, you'd be in this contract here because it has the most open interest. That means there's a lot more people trading this, and it's more liquid than this month here and this month here. It also shows that we have a huge change from here to here. So September's contract might not be the best scenario if it's going to be continuing higher. You would roll into December. So you buy July, hypothetically. I'm not saying you should do it right now. I'm just saying from a teaching perspective. You could be a buyer in the July contract. If it comes to the time where it expires, you wouldn't roll over or sell July by September. You would sell July by December because it's already indicating that it's more interest here in the December contract because it has already more open interest than September's contract. So let's go over to the chart. Here's corn futures. This is the July contract month. And if you go back to April 11th, 2021, and for those folks that download the videos, you can go into your own private library. I promise I don't have any tricks to be able to go in there and change what I said, but I said that this is going to keep going higher, that there would be diversions in here. People would see this as, topping, and it's not. It's going to keep going higher, and it has. It's going up. Now, I want to talk a little bit about the relationship to grain prices, specifically corn, because I talked about this whole thing back here in the August-September time period of 2020. You all have access to those videos, and many of you were here live when I was doing it. I gave you the commentary before we saw this big run up, okay? This is $15,000 of price move per contract. That is a mega trade. I told you this was coming beforehand. Here we have it. Now, I'm not here to pat myself on the back, okay, but I'm trying to remind folks that I'm not just an intraday trader. This is the types of moves that I was looking at when I first started trading back in 1992. I wanted to find these big moves like that. You don't need Bitcoin moves. Okay, you don't need to be trading Bitcoin to make big moves every year. Commodities do it every single year. Every year. It may be a big move like this on the upside, or it may be a big move on the downside. But I want to talk a little bit about the relationship between corn, and specifically corn, not so much wheat and soybeans, as we'll mention them in a moment. But for corn, if we ever see a very sharp price rally, that tends to create an adverse effect on meat prices, like live cattle, because generally corn-fed beef is going to be impacted by higher grain prices. So if we see very, very sharp runs in price like this, higher in corn, that will many times translate into cattle prices going lower. It does not mean that that's the top in the meat market. Remember, all of this is just illustrating what I've been talking about back here and back here. I said that China was going to be accumulating huge amounts of food, grains, and we are the breadbasket of the world, United States. There's been talk about drought in the United States, and you have that on top of food shortage. You also have things where farmers were told to turn over their crops, don't take them to the market, all during the COVID pandemic. And this, to me, still is not done. It's not done. So we could very easily see $12 a bushel corn. We may need to roll over into 2022 to get that price, but listen, I meant what I posted on the forum. I meant what I said back here. Clearly you can see the evidence of it here. And I was talking about it before every news headline ever made its way out on the financial news networks. Before Reuters was talking about it, before Bloomberg, before anybody was talking about it, I was telling you that this was coming. Now, I teach you in this mentorship how to find these moves. Now you're seeing them. This is what mentorship is like. This is what you're going to have after I complete all the content. It isn't we just stop talking. There's no more teachings. It just means my pace slows down and I can talk about the big moves and keep you in focus with what's likely to occur. So there isn't no end to the mentorship after 2021 content and lessons. It just means that I have and will have delivered all of the core content and lessons that I feel make you a well-rounded, institutionally minded trader. Now, I still have lots to teach, but from a structural standpoint, everything I've outlined, that's when I finish. So there isn't this, okay, I'm all tapped out. I'm out of yeast. The baker's got to close up shop now. That's not what this is. It just means that I can now relax a little bit and enjoy, because I don't really enjoy it right now because the pace is too much. But it'll allow me to talk about these types of moves here, and we can focus as a community inside the forum. I won't need to do so many videos to do this. But corn has done a really nice job of continuing rally. And again, I mentioned soybeans would continue higher too. It has. It's done over $5,000 a contract price move in here. Nice little optimal trade entry, fair value gap, bullish order block. I thought that worked on Forex only, Michael. What's this? Relative equal highs. That's the same stuff, isn't it? It's the same stuff. And then finally, wheat. Wheat finally joined the party. Okay, optimal trade entry here. Beautiful rally up. Relative equal highs, the whole business. What are they reacting to? Well, they're reacting to the likelihood that the drought that's being talked about in the headlines may pressure the supply chain on these grains. So countries like China are going to go in and do what? Put massive orders in to buy, because they want to be ahead of everyone and they want to get whatever can be purchased. And that drives up price. These markets are real supply and demand markets. These markets are the ones that actually go up and down because of buying and selling pressure. But notice the difference. If you have the added insight of knowing when a commercial bull market is likely to occur, that means the nearby contracts are more money in price than the distant months away. As I showed on the bar chart, delivery contract months, what the price was and what the open interest was. If prices are going higher in the contract price, that's a normal carrying charge market. If it's ever reversed like we have right now, That is a commercial bull market recipe for huge price runs. Buying down here and getting out right there is $5,000 per contract. Doesn't take long to get that. These types of moves occur whenever there's a scare in supply of a commodity. And grains, whenever you start talking about drought, man, that really gets these markets going if there's already a premium in it. And a premium, I'm not talking about premium high, discount low. I'm talking about the premium relative to its price compared to the next month away and the next month out. Okay? Because commodities have expiration dates. And when you trade them, you have to trade them on a specific contract month or delivery month. Futures have expirations. You have to roll over if you want to be in that move still, or take delivery of the contract. And I'm sure you don't want to take 5,000 bushels of corn at $7 a bushel. Okay, so that's a little bit of money. And I'm sure you don't need that much corn or wheat in this case. But every penny move is 50 bucks per penny. So a dollar move is $5,000. So now if you start thinking that these grains are likely to incur lower harvest yields because of drought and a huge global demand for them that I've warned you about last year, this is going to translate into food prices going through the roof. And this is also the reasons why I've been telling you, and people have been making snide remarks about, they're going to use food as a weapon. Look at it, folks. Look what's going on here. This is just starting. This is going to end up being shown in your grocery receipts at a much higher rate than you're used to paying. And if you're not prepared for that, or not making concession for that, you only have to go, like if you go to the grocer, once a week or whatever, pick up a couple cans of this or that extra. You don't need to go in there. I mean, if you can afford to, obviously get more food. But if you can't, you just buy a little bit each time. Believe me, it doesn't take long to amass, a good chunk of food stocks that are non-perishable. But I would counsel you to do so. So take a look at cattle prices. You'll see that they dropped very sharply with the run up in corn. Corn and beef prices are closely related. And I didn't talk about that in the areas of commodity trading in the mentorship core content. That's something I'm adding here. But it's only important when there is a setting that is a normal market. And this is not a normal market. We are in a global crisis for food. And they're going to put clamps and restrictions on who gets what, how much, and when. And you can clearly see it here. I mean, you can see it. If you can't see this now, it's going to be real obvious in a couple more months. But these are the opportunities that exist when things go bad. You need to understand commodities. That's why I rung that in. Otherwise, if it wasn't important, I'd say, here, just worry about Forex. There's times when the Forex market will be quiet, but the commodity market will explode. What markets tend to explode? Well, in the spring and summer time, grains, meats. What are meats? Live cattle, lean hogs, feeder cattle. What grains do I follow? Wheat, soybeans, and corn. They have oats too, and rice and things of that nature. I don't watch those markets. They're kind of thin. You are having basically specialty markets. Well, what's so special about these markets? I haven't looked at the grain markets for a long, long time until we started this whole pandemic. And now, here you go. You have one more testimony to the ability of what I teach you, working on the highest of time frames that we work with, which is the daily chart. Now, these big moves can be traded if you are not a day trader. If you can't be a Forex intraday trader, Okay, great. That means focus on a higher time frame. That means trade markets like these. Okay, do things like this. Everything you see me do on a lower time frame or in Forex in any time frame really exists here. It's the same stuff, folks. Buy side and balance, sell side and efficiency, institutional order flow entry drill. Buy. Immediate rebalance, rally. Relative equal highs, optimal trade entry, discount, taking sell stops, order block, rally. Institutional order flow entry drill, buy side and balance, sell side and efficiency. It only has to trade to this low or lower. There it is. Rally. What's it doing over here? Optimal trade entry, coming right back into this original buy side and balance. Extend it out in time. Bam. Same stuff, folks. Just a different market, but with a different twist in the underlying narrative. There's a lot of need and want for this market. Believe me when I tell you this. If what I think is coming, and there's going to be this mad dash to get food and countries are going to be looking to buy it, these markets will go limit up. Remember these words. Limit up means they go up as high as they can and you can't get out. You can't buy or sell. It just goes lock limit up. That's what I believe is coming. Days of it. So when you see things like that, put it this way. I think the grain markets, because they're a food, I think they're going to outperform the Bitcoin market. Like everybody's, oh, we missed a big move in Bitcoin. Wait till the world can't get food. You ain't seen the bull markets until then. And that's what I'm trying to tell you. This is what we're building up to. And while we will have a retracement of sorts, that's fine. If that happens, great. I don't think that's the top. That's just, it's cooling down again. And then when that deep discount in price gets to a reasonable level that we like to see, what do you think that China and all these other nations are going to do? They're going to come in with a tsunami of buying and send it way up. That's what I see coming. So while Forex can be quiet, it has been a little quiet recently. These markets haven't been. And I already know what some of you have been talking about, and I can hear you now. We were watching the video. Yeah, but you ain't telling us when to buy. You ain't told us what options to get in. You don't even tell us what broker to trade with. Well, I'm not going to tell you a broker. I don't do that with anything because I'm not introducing broker, and that's trading with live funds. So I talk up to this point here where we're talking about the price and paper trading it. If you cross that line, you've done so on your own. I have not enticed, I've not invited, and I've not made available to you the resources that would link you with a broker with live funds. It's all about compliance, and I'm not stepping into that area. But I'm sure if you did your due diligence, you would find what reputable brokers would allow you to trade commodities or futures. And there you go. But I believe I've given you enough for this weekend's commentary for lesson and lecture. So go back through it again. Make sure you take copious notes because it will serve you well with the content that you'll learn later on in core content. Until I talk to you next time, be safe.